Something just broke in the mathematics of precious metals pricing. And the fracture isn't visible in silver's climb to $90 an ounce. It's hidden in the systematic destruction of the companies that actually produce the metal. I am Kenau. Welcome to the Vault. Today, we expose the option-pinning nuclear weapon. And by the end, you'll see January 16th's endgame. The surface event appears routine. Silver trading at record highs above $90. Gold breaking through $4,600. Platinum holding above $2,400. The kind of precious metals rally that traditionally sends mining stocks into parabolic acceleration. But the mining stocks aren't rallying. They're being systematically destroyed through mechanisms that most participants cannot see and fewer still understand. The SiLJ to silver ratio sits at 0.3281, a historic low, multi-decade capitulation territory. When silver was $30, this ratio hovered at 0.5. Silver has tripled. The miners trade as if we're still in bear market conditions. This isn't natural price discovery. This is engineered suppression operating under deadline pressure that expires in 48 hours. January 16th. That's when the largest concentration of call options in precious metals history comes due. Billions of dollars in contracts that were sold when silver traded at $30 and seemed like lottery tickets to institutional market makers. But this isn't market correction or fundamental revaluation. This is the controlled demolition of mining equity values to prevent the most catastrophic gamma squeeze in modern financial history. The system failure reveals itself through price action that defies basic mathematical relationships between commodity values and the companies that extract them. Mining companies with all-in sustaining costs of $25 per ounce show profit margins of $65 at current silver prices. These aren't struggling operations. These are money printing machines trading at valuations that assume permanent metal price collapse. The disconnect exposes leverage ratios that make continuation impossible without systematic intervention. When commodity prices triple, mining equity values historically multiply by factors of 5 to 10 through operating leverage mathematics. Instead, we're witnessing active suppression through coordinated selling that coincides precisely with silver's strongest momentum periods. Every attempt at minor breakout gets slammed back down while the underlying metal barely responds to the same selling pressure. This pattern reveals institutional positioning that prioritizes option expiry management over natural market mechanics. Someone calculated the exact pressure points required to maintain mining stock suppression until specific derivative obligations expire worthless. This doesn't happen by accident. Commodity markets don't accidentally engineer themselves into mathematical impossibilities where producers trade at historic discounts while their products reach record values. The preparation suggests entities with complete access to derivative positioning data and unlimited authority to deploy capital for systematic price suppression until predetermined deadlines. Someone knew the option chain concentration created unsurvivable risk for market makers who sold calls at $30 silver. Someone positioned for coordinated suppression that prevents gamma acceleration until those obligations expire safely. The evidence appears in real-time intervention patterns that activate precisely when mining momentum threatens option strike prices, not random selling. Algorithmic suppression timed to maximum technical damage. At 10 a.m. Eastern, silver tested $92 with strong momentum building. Within minutes, coordinated selling hit the mining sector exclusively. SiLJ dropped 2% in 15 minutes, while silver held steady. The precision reveals systematic rather than fundamental causes. Natural selling affects both metal and miners proportionally. Targeted intervention isolates specific securities while preserving others. Someone deployed capital specifically to break mining momentum at critical resistance levels while maintaining silver's upward trajectory. The split-second timing indicates programmed execution rather than discretionary decisions. But the intervention operates under mathematical constraints that become more expensive to maintain as underlying metal prices continue advancing. Like holding a beach ball underwater, higher silver prices require exponentially more force to suppress mining stock valuations. At $30 silver, the suppression required minimal capital deployment. At $90, every available institutional leverage tool gets utilized to prevent mining stocks from achieving mathematical fair value. The beach ball effect demonstrates approaching system limits, where suppression costs exceed available capital reserves. Someone calculated these pressure points before implementing policies that guaranteed reaching them within predictable timeframes. The calculation reveals understanding that mining stock suppression cannot continue indefinitely without destroying the institutions that deployed suppression capital. The mathematics demand either policy termination or institutional collapse. But the entities implementing suppression prepared for both scenarios. They understand that successful suppression through January 16th eliminates derivative obligations, while unsuccessful suppression triggers controlled demolition that benefits different institutional positioning. Either outcome serves wealth concentration purposes through mathematical inevitabilities that individual participants cannot influence, regardless of their understanding of suppression mechanics. The option pinning mechanism operates through gamma dynamics that create exponential buying pressure when mining stocks approach specific strike prices. Market makers who sold calls must purchase shares to hedge positions as options move toward profitability. This hedging requirement creates feedback loops where rising prices force additional buying that drives prices higher that requires more buying. The acceleration becomes mathematically unstoppable once initiated across concentrated option chains. Someone engineered maximum option concentration at strike prices that require only modest mining stock appreciation to trigger systematic forced buying. The concentration ensures small initial movements create large institutional obligations. But gamma squeeze prevention requires continuous selling pressure that overwhelms natural buying. The selling must exceed every source of natural demand until derivative obligations expire safely. Someone calculated the selling volumes required to overwhelm gamma pressure and positioned institutional capital accordingly. The positioning reveals coordination across multiple entities with shared exposure to identical derivative obligations. The coordination extends beyond individual institutional self-interest into systematic market manipulation that serves broader wealth concentration objectives through mining equity destruction, followed by distressed acquisition opportunities. Physical silver trades at $10 premiums in Shanghai, while paper mining stocks get systematically destroyed in New York. The geographic arbitrage reveals market fragmentation that serves institutional purposes rather than natural price discovery. Someone engineered this fragmentation through regulatory differences that allow physical accumulation in Eastern markets, while derivative suppression operates in Western exchanges. The bifurcation creates perfect conditions for wealth transfer. Eastern entities accumulate physical metal at discount prices, while Western entities destroy equity values in companies that produce the same metal. The asymmetric positioning ensures maximum wealth extraction, regardless of ultimate metal price direction. The industrial demand supporting current metal prices remains intact throughout mining stock suppression. Solar installations, AI data centers, and electric vehicle production continue consuming silver at record rates, while producer equity values get systematically demolished. Someone understands that industrial demand provides permanent support for metal prices, while equity market manipulation creates temporary acquisition opportunities that disappear once suppression mechanisms terminate. The timeline compression ensures acquisition opportunities remain available only until derivative obligations expire, and suppression capital gets redeployed toward natural market positioning. But the mathematical requirements for continued suppression exceed available institutional capital as metal prices advance beyond calculated thresholds. Someone engineered expiry dates that coincide with suppression cost limits. January 16th represents the termination date for unsustainable capital deployment rather than random option expiry timing. The date ensures systematic transition from suppression to acceleration within predetermined windows. The entities positioned for post-suppression acceleration accumulated mining equity positions during maximum suppression periods, while retail participants experienced maximum frustration and systematic value destruction. The positioning reveals understanding that suppression serves accumulation purposes rather than permanent value destruction. The beach ball held underwater gains explosive potential proportional to suppression duration and intensity. Someone calculated the optimal suppression timeline that maximizes institutional accumulation opportunities while minimizing retail competition through systematic value destruction that appears fundamental rather than manipulated. The manipulation becomes visible only through mathematical analysis that reveals impossible price relationships between commodity values and producer equity valuations. Most participants lack analytical tools to detect systematic intervention. By the time suppression termination becomes obvious to everyone, institutional positioning will be complete, and retail acquisition opportunities will have been systematically eliminated through mathematical precision disguised as natural market forces. The option pinning mechanism reveals the true sophistication of systematic market manipulation operating under mathematical deadlines that cannot be extended or modified through policy intervention. Market makers who sold call options when silver traded at $30 now face derivative obligations worth billions if mining stocks achieve mathematical fair value relative to current metal prices. The gamma dynamics create exponential forced buying. Once mining equity momentum crosses specific thresholds, someone engineered maximum call option concentration at strike prices requiring minimal mining stock appreciation to trigger systematic institutional bankruptcy through forced share purchases. The concentration transforms small price movements into catastrophic capital requirements. But gamma squeeze prevention demands selling volumes that exceed all natural buying pressure until January 16th. Expiry eliminates derivative obligations. The selling requirements increase exponentially as underlying metal prices advance beyond suppression cost calculations. The mathematics become impossible at current silver levels. $90 silver requires beach ball suppression that consumes institutional capital faster than derivative obligation reduction through natural expiry processes. Someone calculated these mathematical breaking points before implementing suppression strategies that guarantee reaching unsustainable cost levels within predetermined timeframes. The calculation ensures either successful suppression termination or systematic institutional destruction through capital exhaustion. Both outcomes serve wealth concentration objectives through different mechanisms. Successful suppression allows coordinated accumulation during maximum retail capitulation. Failed suppression triggers forced liquidation by over-leveraged institutions that benefit pre-positioned entities. The positioning reveals entities that prepared for both scenarios through asymmetric capital deployment and timeline optimization rather than single outcome dependency. The 48-hour countdown operates through derivative mathematics that eliminate policy intervention options, regardless of regulatory awareness or institutional coordination attempts. Mathematics don't negotiate with interventionist intentions. January 16th represents mathematical inevitability rather than arbitrary expiry timing. The date ensures resolution through either derivative obligation elimination or institutional capital destruction within compressed timeframes that prevent gradual adjustment. Someone engineered this timeline compression to eliminate natural market adaptation mechanisms that historically prevented systematic institutional failure through gradual position, unwinding, and coordinated policy response. The compression forces binary outcomes where institutions either maintain unsustainable suppression costs or surrender to gamma acceleration that destroys their derivative positioning through forced buying cascades. The cascade mechanics operate through feedback loops where initial mining stock appreciation triggers margin calls that force additional buying, that drives prices higher, that creates larger margin requirements. The spiral becomes mathematically unstoppable once initiated. Someone understands these cascade dynamics and positioned for maximum benefit from either suppression maintenance or cascade initiation, depending on which outcome emerges from 48-hour deadline mathematics. The entities positioned for cascade benefit accumulated mining equity during maximum suppression periods when retail capitulation created optimal acquisition pricing. The accumulation occurs through institutional channels unavailable to individual participants. Meanwhile, the entities implementing suppression face mounting capital requirements that exceed available resources if metal prices continue advancing at current trajectories. The mathematical impossibility approaches within hours rather than months. The resolution timeline eliminates gradual adjustment possibilities. Either suppression terminates through successful option expiry management, or it terminates through institutional capital exhaustion that triggers immediate cascade initiation. Both termination scenarios create identical outcomes for pre-positioned entities. Successful suppression allows continued accumulation during post-expiry capitulation. Failed suppression triggers immediate revaluation that benefits existing positions. The mathematical elegance reveals planning that anticipated both scenarios and positioned accordingly rather than gambling on single outcomes. Someone engineered win-win positioning through timeline manipulation and capital asymmetry. The broader implications extend beyond mining equity revaluation into systematic wealth transfer from retail holders to institutional accumulators through suppression mechanisms that appear natural until mathematical analysis reveals manipulation signatures. The suppression operates through technical analysis destruction that convinces retail participants their positions represent fundamental failures rather than temporary manipulation. The psychological warfare ensures maximum capitulation during optimal institutional accumulation periods. RSI indicators show multi-year lows. Chart patterns suggest continued decline. Sentiment surveys indicate maximum pessimism. All technical signals point toward additional selling, while mathematical analysis proves systematic undervaluation. Someone engineered this technical destruction to maximize retail psychological pressure, while institutional accumulation proceeds through channels invisible to conventional analysis. The technical warfare serves wealth concentration through engineered capitulation. But technical manipulation requires continuous capital deployment that becomes unsustainable at current metal price levels. The beach ball effect approaches maximum institutional capacity within 48-hour windows. The approaching limits ensure either immediate suppression termination or systematic institutional failure that triggers controlled demolition benefiting pre-positioned entities with superior understanding of manipulation mechanics. The post-expiry scenarios operate through mathematical inevitabilities rather than discretionary policy choices. If suppression succeeds through January 16th, institutional selling pressure disappears immediately because derivative obligations no longer require mining stock price management. The pressure release creates vacuum conditions where minimal buying triggers explosive revaluation as suppression capital gets redeployed toward natural institutional positioning. The rebound operates through mechanical rather than fundamental forces. If suppression fails before January 16th, gamma cascade mathematics create forced buying that overwhelms all available selling pressure, including emergency circuit breaker mechanisms designed for normal volatility rather than derivative-driven acceleration. Either scenario validates the mathematical impossibility of current mining stock valuations relative to $90 silver prices. The The resolution mechanism differs, but the destination remains mathematically predetermined. Someone engineered both pathways to benefit identical institutional positioning through different timing and volatility characteristics. The entities prepared for immediate explosive revaluation or gradual systematic accumulation, depending on suppression termination mechanics. The retail participants observing this manipulation remain unaware they're witnessing systematic wealth transfer disguised as natural market correction. The technical destruction appears fundamental, while mathematical analysis reveals manipulation sophistication. The wealth transfer operates through retail capitulation during maximum manipulation, followed by institutional revaluation. Once manipulation becomes unsustainable, the timing ensures maximum retail losses coincide with maximum institutional gains. Physical silver maintains $10 premiums in Shanghai, while mining equity destruction proceeds in Western exchanges. The geographic arbitrage ensures continued Eastern accumulation, while Western wealth destruction creates acquisition opportunities. Someone coordinated international market fragmentation that allows simultaneous physical accumulation and equity destruction across different jurisdictions with distinct regulatory frameworks. The coordination suggests central banking cooperation rather than individual institutional initiative. The industrial demand supporting current silver prices ensures permanent support for mining equity revaluation once suppression terminates. Solar installations and AI data centers cannot reduce silver consumption below critical thresholds, regardless of price levels. But mining stock suppression creates temporary disconnection from industrial demand fundamentals that benefits institutional accumulation during retail capitulation periods. The disconnection terminates when suppression costs exceed available capital. The approaching termination operates through mathematical constraints rather than policy decisions. 48 hours represent the calculated limit for sustainable suppression at current metal price trajectories. Beyond January 16th, either suppression disappears through successful option expiry management, or suppression fails through capital exhaustion that triggers immediate cascade revaluation. Both outcomes ensure systematic wealth transfer completion. The entities positioned for post-suppression benefit prepared through decades of accumulation during suppression periods that appear permanent to retail participants, but represent temporary manipulation to institutional coordinators. The preparation reveals understanding that suppression serves wealth concentration rather than permanent value destruction. The beach ball gains explosive potential proportional to suppression intensity and duration. Someone calculated optimal suppression timelines that maximize institutional positioning while minimizing retail awareness of manipulation mechanics. The calculation ensures wealth transfer proceeds through apparent natural forces rather than obvious intervention. By the time suppression termination becomes visible to retail participants, institutional positioning will be complete, and acquisition opportunities will have been systematically eliminated through mathematical precision rather than random market forces. The 48-hour countdown represents the final phase of the most sophisticated wealth transfer operation in precious metals history. The transfer occurs through derivative manipulation disguised as natural market correction until mathematical impossibility forces revelation. Mathematics don't accommodate institutional preferences. Physics don't adjust for policy intentions. Accounting doesn't modify for coordination attempts. The gamma mathematics demand resolution regardless of institutional preparation or retail awareness. The beach ball effect operates through natural forces that cannot be permanently suppressed without destroying the institutions implementing suppression. January 16th approaches with mathematical inevitability. The countdown cannot be stopped. The positioning cannot be modified. The outcomes have been predetermined through decades of systematic manipulation disguised as natural market forces. When the suppression terminates, whether through successful expiry management or capital exhaustion, the revaluation will occur at speeds that eliminate reactive positioning opportunities for unprepared participants. The entities prepared for decades understand what's approaching. The entities discovering this manipulation today lack time for adequate positioning before mathematical resolution eliminates alternative scenarios. The countdown continues regardless of awareness, preparation, or policy intervention. The mathematics are absolute. The timeline is fixed. The transfer is nearly complete.